On the 11th of March 2024, something happened that almost no one noticed. The Federal Reserve quietly terminated an emergency lending facility for banks called the Bank Term Funding Program. There was no press conference, no primetime news coverage, no explanation to the American people. This program had been created just 1 year earlier, in the panic of March 2023, when Silicon Valley Bank collapsed and the entire regional banking system teetered on the edge of systemic failure. The Bank Term Funding Program was the safety net, the emergency backstop that allowed banks to borrow against their underwater bond portfolios without having to realize catastrophic losses. It was the thing preventing contagion. And on the 11th of March 2024, the Federal Reserve simply turned it off. The official story you've been told is that the economy has achieved a soft landing. Inflation has been tamed. The job market remains strong. The banking system is stable. The crisis has been averted. But if that were true, why would the Federal Reserve remove the very mechanism designed to prevent another banking panic? If the patient has recovered, why remove life support without warning? The removal of the Bank Term Funding Program was not a vote of confidence. It was the deliberate reintroduction of fragility into a system that is already cracking beneath the surface. They didn't remove the safety net because we don't need it anymore. They removed it because they need the fall. Here is the paradox that should keep you awake at night. The U.S. Government is now issuing over $1 trillion in new debt every 100 days. That is not the behavior of an economy that has achieved stability. That is the behavior of a system that is consuming itself to survive just a few more months. At the same time, central banks around the world are buying physical gold at a rate not seen since 1971, the year President Richard Nixon closed the gold window and ended the last remnants of the gold standard. When central banks abandon their own paper currencies and hoard gold, they are not investing. They are preparing. They know something the public does not. And there is one more data point that the financial media refuses to discuss. The yield curve, specifically the spread between the 10-year Treasury bond and the 2-year Treasury bond, has been inverted for over 18 consecutive months. This is the longest inversion in modern financial history. Every single time this inversion has occurred, a recession has followed. Not sometimes, not usually. Every single time. And yet, we are told that this time is different. This time, the old rules don't apply. This time, we have achieved a new paradigm of permanent stability. I am going to show you why that is a lie. I am going to walk you through the exact mechanism the Federal Reserve has constructed. I am going to show you the delayed fuse they have lit, the target they have selected, and the precise timeline for when this trap is designed to spring shut. And I am going to connect it to a historical precedent that proves this is not speculation. It is a playbook they have run before. In 1980, Paul Volcker, the chairman of the Federal Reserve, made a decision that would destroy the presidency of Jimmy Carter, and he did it on purpose. Let's go back to 1979. America was in chaos. Inflation was running at over 13%. The purchasing power of the dollar was evaporating. Gas lines stretched for blocks. The Iranian hostage crisis dominated the news, but behind the scenes, the real emergency was monetary. The Federal Reserve, under the leadership of Volcker's predecessor, had lost control. The Bretton Woods system had collapsed in 1971. The gold standard was gone. The dollar was unmoored. And inflation, the invisible tax that erodes savings and wages without legislation or debate, was spiraling out of control. Paul Volcker was appointed chairman of the Federal Reserve in August 1979. He was a towering figure, both literally and institutionally. 6'7", a chain-smoking economist who believed in the sanctity of the dollar above all else. He looked at the inflation data and made a decision that would come to define an era. He would break inflation, no matter the cost, and the cost would be extraordinary. In October 1979, Volcker's Federal Reserve began raising interest rates. But this was not a gentle tightening. This was scorched earth monetary policy. By the spring of 1980, the federal funds rate, the rate at which banks lend to each other overnight, had been raised to 20%. 20%. Mortgages became impossible. Car loans vanished. Businesses could not borrow. The economy went into a violent contraction. Unemployment soared past 10%. Entire industries collapsed. The housing market froze. The auto industry was devastated. It was a deliberate, induced recession. And Paul Volcker knew exactly what he was doing. He understood that inflation is not just an economic phenomenon. It is a political one. As long as inflation raged, the public would demand action. They would blame the president. They would vote for change. The 1980 presidential election became a referendum on economic pain. Jimmy Carter, the incumbent, tried to defend his record, but the numbers were indefensible. Inflation, unemployment, and interest rates were all in double digits. It became known as the misery index. And in November 1980, Ronald Reagan won in a landslide. The official history tells us that Volcker was a hero. He broke the back of inflation. He saved the dollar. He restored credibility to the Federal Reserve. But there is another way to read this history. Paul Volcker used monetary policy as a weapon to end a presidency. Whether his motives were purely economic or whether there was a political calculation is a question historians still debate. But the outcome is not debatable. A determined Federal Reserve chairman raised interest rates to levels that guaranteed a deep recession, and that recession cost an incumbent president his office. The precedent was set. The Federal Reserve has the power, the independence, and the willingness to trigger an economic crisis if it believes the long-term objectives of the institution are at stake. And that precedent is not ancient history. It is the playbook. And in 2024, that playbook is being run again. The Federal Reserve began raising interest rates in March 2022. The official reason was clear. Inflation had spiked to levels not seen in 40 years. The Consumer Price Index peaked at over 9% in June 2022. The Fed, under Chairman Jerome Powell, had kept rates at zero for too long. The pandemic stimulus, the money printing, the trillions in government spending had flooded the system with liquidity. And now, prices were rising uncontrollably. The Fed had to act, and so they did, aggressively. By July 2023, the federal funds rate had been raised to a range of 5.25 to 5.5%. That is the highest level in 23 years. And then, something strange happened. The Fed stopped raising rates, but they did not cut them. Month after month, meeting after meeting, they held rates at that elevated level. They called it higher for longer. They said they needed to ensure that inflation was truly defeated, that it would not come roaring back. They said they were being cautious, data-dependent, responsible, but here is what they do not say publicly. Inflation peaked in June 2022. By the end of 2023, inflation had fallen to around 3%. It was no longer a crisis. The emergency was over. And yet, the Fed kept rates at a 23-year high throughout all of 2024. Why? If inflation is no longer the threat, why keep the medicine at full dose? Why continue to apply maximum pressure to an economy that is already showing signs of strain? The answer is not about inflation. The answer is about time. Every month that interest rates remain elevated, every month that borrowing costs stay high, the damage accumulates. But it does not show up immediately. It is a delayed fuse. The economy does not collapse the moment rates go up. It takes 12 to 18 months for higher interest rates to fully propagate through the system. Loans that were taken out at low rates eventually mature. They must be refinanced. Businesses that could survive at 3% interest cannot survive at 7%. Commercial real estate projects that were feasible at near zero rates become financially impossible at current rates. The Federal Reserve knows this. They have econometric models that predict these lag effects with startling precision. They know that the true impact of the rate hikes of 2022 and 2023 will not fully materialize until 2025. And they are holding rates high to ensure that when the impact comes, it is catastrophic. There is another signal that confirms this is not about inflation. It is about the yield curve. The yield curve is the difference in interest rates between short-term Treasury bonds and long-term Treasury bonds. Normally, long-term bonds pay higher interest rates because investors demand compensation for the risk of holding a bond for 10 or 30 years. But when the Federal Reserve raises short-term rates aggressively, the yield curve can invert. The 2-year Treasury bond starts paying a higher interest rate than the 10-year Treasury bond. This inversion is one of the most reliable recession predictors in all of economics. And right now, the yield curve has been inverted for over 18 months. That is the longest inversion in modern history. It has never been wrong. Every time the yield curve inverts and stays inverted, a recession follows. Not sometimes, every single time. And yet, the Federal Reserve continues to insist that this time is different. They say the old models don't work anymore. They say we've entered a new era. But the yield curve is not a model. It is a market signal. It is the collective wisdom of every bond trader, every pension fund, every foreign central bank, all voting with real money on what they believe is coming. And what they believe is coming is a recession. The bond market is screaming that a contraction is inevitable, and the Federal Reserve is pretending not to hear. The weapon is not just high interest rates. The weapon is the duration. The longer they hold rates at these levels, the more debt must be refinanced at punishing terms. The more businesses face impossible borrowing costs. The more the delayed fuse burns down toward detonation. And the detonation is timed for early 2025. The target of this monetary weapon is not the stock market. It is not cryptocurrencies. It is not even the housing market, though housing will certainly suffer. The target is the $20 trillion commercial real estate market. And within that market, the epicenter of the coming collapse is office buildings. Here is the scale of the problem. Across the United States, there is approximately $1.5 trillion in commercial real estate debt that must be refinanced by the end of 2025. These are not small loans. These are the mortgages on skyscrapers, office parks, shopping centers, hotels. And these loans were underwritten in a different era. They were written in 2020, 2021, and early 2022, when interest rates were near zero, when the Federal Reserve was buying bonds to suppress yields, when borrowing was as cheap as it had ever been in human history. A developer could borrow at 2 or 3% interest to build or refinance an office tower. The math worked. The cash flows from rents could cover the debt service. The buildings were appraised at high valuations because low interest rates meant future cash flows were discounted at low rates, making the properties appear very valuable. Everything was stable as long as rates stayed low. But rates did not stay low. And now, those loans are maturing. They must be refinanced. And the interest rate on a new commercial real estate loan today is not 2%, it is not 3%. It is 6, 7, or 8%, depending on the property and the market. That is a tripling or quadrupling of the debt service cost. For many properties, it is mathematically impossible to refinance. The rental income cannot cover the new debt payments. And it gets worse. The underlying value of office buildings has collapsed. The pandemic changed everything. Remote work is not a temporary trend. It is a permanent restructuring of the American economy. Companies have realized they do not need as much office space. Employees have realized they do not want to commute 5 days a week. Office vacancy rates in major cities are at historic highs. In San Francisco, the office vacancy rate is over 30%. In New York, entire towers sit half empty. In Chicago, downtown streets are ghost corridors during the work week. When a building is half empty, the rental income collapses. When rental income collapses, the value of the building collapses. Office buildings in prime urban locations have lost 50 to 70% of their value since 2021. A tower that was appraised at $500 million is now worth $200 million. But the debt on that building is still $500 million. The loan is now underwater. The building is worth less than the mortgage. When these loans come due in 2025, the owners face an impossible choice. They can try to refinance at the new, higher interest rate, but the building is worth less than the debt, and no lender will provide a new loan for more than the building is worth. Or they can try to sell the building, but there are no buyers at anything close to the price needed to pay off the loan. Or they can simply walk away. Default. Hand the keys to the lender. Declare bankruptcy. And that is exactly what is beginning to happen. Across the country, commercial real estate defaults are accelerating. The headlines are starting to trickle out. A major office building in Los Angeles defaults. A landmark tower in Manhattan is sold at a 70% loss. A developer in Dallas files for bankruptcy. These are not isolated incidents. This is the beginning of a wave. $1.5 trillion in commercial real estate debt is coming due by the end of 2025. Much of it cannot be refinanced. The properties are underwater. The defaults will cascade. And the question is, who is holding this debt? Who will absorb the losses when the defaults arrive? The big banks, the systemically important financial institutions like JP Chase, Bank of America, and Goldman Sachs, are not the primary holders of commercial real estate debt. After the 2008 financial crisis, these banks were subjected to stress tests, higher capital requirements, and intense regulatory scrutiny. They diversified. They reduced their exposure to risky real estate loans. They learned the lesson of 2008. But there are over 4,000 banks in the United States, and the vast majority of them are not JP Morgan. They are regional banks, community banks, small lenders with balance sheets concentrated in their local geographies. And these banks did not diversify. They doubled down. Commercial real estate lending is their bread and butter. It is how they compete with the giants. They know the local market. They know the developers. They fund the office buildings, the shopping centers, the apartment complexes. Their balance sheets are heavily weighted toward commercial real estate. And that means when the commercial real estate market collapses, these banks collapse with it. This is not speculation. We have already seen the preview. In March 2023, Silicon Valley Bank failed. It was the second largest bank failure in American history. The failure was triggered by a classic bank run, but the underlying cause was simple. The bank's assets, primarily long-term bonds, had lost value because interest rates had risen. The bank was insolvent. Depositors panicked. The bank collapsed in under 48 hours. Silicon Valley Bank was followed by Signature Bank and then First Republic Bank. 3 major regional banks failed in the span of weeks. The entire regional banking system was on the brink of a contagion event. Depositors at other regional banks began to panic. If Silicon Valley Bank could fail overnight, what about their bank? The fear was rational and spreading. The Federal Reserve and the Treasury Department intervened with emergency measures. They created the Bank Term Funding Program. They guaranteed deposits. They provided unlimited liquidity. They stopped the contagion. The BTFP allowed banks to borrow against their underwater bond portfolios at par value, meaning they did not have to realize the losses. It was a bailout in everything but name. And it worked. The panic subsided. The system stabilized. But the underlying problem was not solved. It was papered over. The banks still hold underwater assets. The commercial real estate loans are still on their balance sheets. And now, with the BTFP terminated in March 2024, the safety net is gone. When the commercial real estate defaults accelerate in 2025, there will be no emergency program to stop the losses. The banks will have to realize the losses. Their capital will be wiped out. They will fail. And when a bank fails, it does not fail in isolation. Banking is a confidence game. The system runs on trust. When depositors see one bank fail, they begin to question the safety of their own bank. They withdraw their money. That forces the bank to sell assets at a loss to meet the withdrawals. That crystallizes more losses. That triggers more withdrawals. The spiral accelerates. This is contagion. The Federal Deposit Insurance Corporation, the FDIC, is supposed to protect depositors. The FDIC insures deposits up to $250,000 per account, but the FDIC's deposit insurance fund holds only about $120 billion. That sounds like a lot until you realize that there are trillions of dollars in deposits across the regional banking system. If multiple large regional banks fail simultaneously, the FDIC does not have the resources to cover the losses. The fund would be exhausted almost immediately. At that point, the federal government would be forced to step in with a much larger bailout. But this time, the political environment is different. This time, the crisis will not be blamed on a pandemic or a financial accident. It will be blamed on the policies of the new administration. The crisis is being timed to arrive in the first 100 days of the next presidency, and that is not a coincidence. Let's map out the sequence of events as they are designed to unfold. This is not guesswork. This is the predictable outcome of the mechanisms that have already been set in motion. Stage 1 is the facade of stability. This is where we are now, in the final months of 2024. The narrative is carefully controlled. The economy is stable. The soft landing has been achieved. Inflation is under control. The stock market is near all-time highs. The Federal Reserve has declared victory. The media repeats the message. Everything is fine. But beneath the surface, the defaults are beginning. They are not front-page news yet. A commercial real estate loan in Phoenix defaults. A small regional bank in Ohio reports losses on its real estate portfolio. These events are reported in the business press, but they are framed as isolated incidents, not the beginning of a trend. The public is not alarmed because the public is not being told the scale of what is coming. Behind closed doors, the banks know. They are quietly tightening lending standards. They are building reserves. They are preparing for losses. But they cannot say this publicly because that would trigger the very panic they are trying to avoid. So the facade holds, through the election, through the end of the year. The system appears stable, but it is a Potemkin village. The structure is hollow. Stage 2 begins in the first quarter of 2025. On the 20th of January 2025, a new president is inaugurated. Let's say, for the sake of this timeline, that it is a president the financial establishment did not support, a populist, an outsider, someone who campaigned on disrupting the system. Within weeks of the inauguration, the first major regional bank fails. It is not a small community bank. It is a significant institution with tens of billions in assets and a large commercial real estate portfolio. The failure happens quickly, over a weekend, just like Silicon Valley Bank. The Federal Reserve and the Treasury attempt to contain it, but this time, the BTFP is gone. There is no emergency lending program. The FDIC steps in, but the losses are enormous. Depositors at other regional banks begin to panic. This is the moment the contagion begins. Within days, deposit outflows at regional banks accelerate. The banks are forced to sell assets. The commercial real estate market, already weak, collapses as distressed sales flood the market. This drives down valuations further, which creates more losses for other banks. The spiral is in motion. By March or April 2025, multiple regional banks have failed. The stock market is in free fall. The S&P 500 has dropped 30, 40, 50% from its highs. Credit markets freeze. Businesses cannot borrow. The flow of capital stops. Small and medium-sized businesses, which employ nearly half of the American workforce, begin to lay off employees. Unemployment spikes. The media narrative shifts immediately. This is no longer framed as a structural problem that began years earlier. It is framed as a political crisis. The new president's policies are blamed. The market is said to be reacting to political instability, to regulatory uncertainty, to the disruption of norms. The crisis is given a name: the Trump recession, the populist crash, the Second Great Depression. The framing is everything. The public is told that this is what happens when you elect an outsider. This is what happens when you disrupt the system. But the trap was set long before the election. The commercial real estate debt calendar was locked in years ago. The Fed's decision to hold rates high throughout 2024 ensured the fuse would burn down to detonation in early 2025. The removal of the BTFP in March 2024 ensured there would be no safety net to stop the fall. Every piece was positioned. The new president simply walked into the kill zone. Stage 3 arrives later in 2025 and into 2026. The crisis is now in full bloom. The banking system is in chaos. The stock market has lost 60, 70, 80% of its value. Unemployment is rising toward double digits. The public is frightened, angry, and desperate. They are demanding action. They are demanding solutions. And that is when the solution is unveiled. Before we get to the solution, we need to understand who profits from this crisis. Because every financial collapse is also a transfer of wealth. The wealth does not disappear. It changes hands. And in this crisis, the transfer will be historic. When the stock market crashes, the retirement accounts of millions of Americans will be devastated. The 401(k)s, the IRAs, the pension funds, all of them are invested in equities. When the market loses 60 or 70% of its value, those accounts lose 60 or 70% of their value. A retiree who spent 40 years saving for retirement will see their nest egg cut in half, or worse. This is not a theoretical harm. This is the destruction of life savings. But while the public is being wiped out, there are institutions that are positioning to profit. Private equity firms, sovereign wealth funds, and the largest asset managers in the world have been raising enormous pools of capital over the past 2 years. They have been moving to cash. They have been waiting. And when the crash comes, they will deploy that capital to buy distressed assets at fire sale prices. Office buildings that were worth $500 million will be purchased for $100 million. Stocks that were trading at $60 per share will be bought at $10 per share. Infrastructure, farmland, entire companies will be acquired for pennies on the dollar. This is not opportunism. This is the plan. The largest transfer of wealth in modern history will occur in the span of 12 to 18 months. The firms that will benefit are not obscure. They are BlackRock, Vanguard, Apollo Global Management, KKR, Blackstone. These are the asset managers that already control trillions of dollars. And after this crisis, they will control even more. The consolidation of wealth and ownership will reach levels never before seen in the American economy. A handful of firms will own a staggering percentage of American real estate, American businesses, and American infrastructure. And here is the part that is rarely discussed. This consolidation is not just economic, it is political. When a small number of firms control such a large share of the economy, they control policy, they control politicians, they control outcomes. The crisis will not just transfer wealth, it will transfer power. And that power will be used to ensure that the new system, the system that emerges from the crisis, serves the interests of those who now own everything. This is not a conspiracy theory. This is how every financial crisis in history has functioned. The Great Depression transferred wealth to those who had cash. The 2008 crisis transferred wealth to the banks that were bailed out. And the 2025 crisis will transfer wealth to the asset managers and private equity firms that are positioned to buy the ruins. The mechanism is always the same. Create a crisis, destroy the middle class, buy the assets, consolidate control. As the crisis reaches its peak in late 2025, the public will be desperate for relief. Unemployment is soaring. Savings have been wiped out. Businesses are failing. The banking system is in chaos. People cannot access their money. The ATMs are not working. Credit cards are being declined. There is a genuine emergency. And in that moment of desperation, the Federal Reserve and the U.S. Treasury will unveil the solution. It will be framed as a rescue, as relief, as the only way to get money directly to the people who need it. The mechanism will be a digital dollar distributed directly from the Federal Reserve to individuals. No banks as intermediaries. No delays. Instant deposits into digital wallets. It will be called a stimulus. It will be compared to the checks that were sent out during the pandemic. It will be sold as compassionate, efficient, and necessary. But this will not be a temporary measure. This will be the rollout of a central bank digital currency, a CBDC, and the infrastructure is already in place. In July 2023, the Federal Reserve launched a payment system called FedNow. The official description is that it is a real-time payment and settlement service. It allows money to be transferred instantly, 24 hours a day, 7 days a week. The Federal Reserve said it was designed to modernize the payment system. But FedNow is also the rail on which a CBDC would run. It is the infrastructure that would allow the Federal Reserve to deposit money directly into the accounts of every American. No commercial bank required. And in the crisis of 2025, that is exactly what will happen. The Federal Reserve will announce that every citizen is eligible to open a Fed account, a digital wallet hosted directly by the central bank. And into that account, the Fed will deposit digital dollars. At first, the public will be grateful. They need the money. The economy has collapsed. This is survival. But what they will not immediately understand is what they have accepted. A central bank digital currency is not the same as cash. It is not the same as a bank account. It is programmable money. That means the issuer, the Federal Reserve, can attach conditions to how it is used. The digital dollar can have an expiration date. Spend it within 90 days, or it disappears. This is designed to force consumption, to prevent saving, to eliminate the possibility of hoarding cash. The digital dollar can have geographic restrictions. It can only be spent in certain areas, to encourage local spending or to restrict movement. The digital dollar can have category restrictions. You cannot use it to buy certain goods: alcohol, firearms, gasoline, whatever the policy objective is. And every transaction is recorded. Every purchase you make, every payment you receive, every transfer you initiate is visible to the Federal Reserve, to the Treasury, to the IRS, to law enforcement. Financial privacy will cease to exist. The government will have a complete, real-time record of every economic decision you make. This is not a hypothetical. This is what a CBDC enables by design. But it gets worse. In the chaos of the crisis, the government will also move to consolidate the banking system. The regional banks that failed will not be allowed to remain independent. They will be absorbed by the systemically important institutions. The big banks will get bigger, and there will be new rules. Depositors at failed banks will not be fully bailed out. Instead, a mechanism called a bail-in will be used. This means that depositors become creditors. Their deposits are converted into equity in the failed bank. They are not made whole, they take a loss. This has already been done in Cyprus in 2013 and in Italy in 2015. The legal framework exists. It will be used. The combination of a CBDC and a consolidated banking system means the end of financial independence. You will not be able to opt out. Cash will be phased out, declared unsafe or obsolete. Physical gold and silver will be difficult to transact with. The only functional money will be the digital dollar, and the digital dollar is controlled by the Federal Reserve. Every aspect of your economic life will be monitored, restricted, and programmable. This is not a dystopian fantasy. The technology exists. The legal authorities exist. The infrastructure has been built. FedNow launched in July 2023. Central banks around the world are piloting CBDCs. The Bank for International Settlements, the central bank for central banks, has published extensive research on the design and implementation of CBDCs. The only thing missing was the crisis that would make the public accept it. And that crisis is being engineered for 2025. The crash is not the goal. The crash is the pretext. The crash is the emergency that justifies the rollout of a system of control that the public would never accept under normal circumstances. This is the same playbook that has been used throughout history. Create the crisis, offer the solution, consolidate the power. Let's be clear about something. This is not a matter of opinion. This is not a prediction based on sentiment or politics. This is a matter of mathematical inevitability. The numbers do not lie, and the calendar does not bend. $1.5 trillion in commercial real estate debt is coming due by the end of 2025. That is not a projection. That is a fact. These are loans with maturity dates that are already locked in. The borrowers must either refinance the loans or default. And refinancing at current interest rates is, for a large portion of these loans, mathematically impossible. If a property was generating $10 million a year in rental income and the debt service at 3% interest was $7 million per year, the property was profitable. But if that same loan must be refinanced at 7% interest, the debt service becomes $15 million per year. The property is now generating a loss of $5 million per year. No lender will refinance that loan. The property will default. This is not speculation. This is arithmetic. And the scale of the problem is not small. We are talking about hundreds of billions of dollars in losses that will be realized over the next 12 to 18 months. The banks that hold this debt will be insolvent. The FDIC does not have the resources to cover the losses. The federal government will be forced to intervene, and that intervention will come with conditions, with new rules, with a new system. The yield curve has been inverted for over 18 months. This is the longest inversion in modern history. The yield curve has never been wrong. Every time it inverts and stays inverted, a recession follows. The bond market is telling us, in the clearest possible terms, that a contraction is coming. And yet, the Federal Reserve and the Treasury continue to insist that this time is different. But the bond market is not a sentiment survey. It is a price discovery mechanism where trillions of dollars are at stake. The smartest investors in the world, the people who manage pension funds and sovereign wealth funds, are positioning for a recession. They are moving to cash. They are buying Treasury bonds, which is why the long end of the curve is suppressed. They know what is coming. The question is whether the public will understand before it is too late. And then there is the gold signal. Central banks around the world are buying physical gold at levels not seen since 1971. In 2022 and 2023, central banks purchased over 2,000 metric tons of gold. That is the highest rate of accumulation in 50 years. Why? Central banks do not buy gold because they think it is going to go up in price. Central banks buy gold because they are losing confidence in the dollar-based system. They are hedging against a monetary reset. When the People's Bank of China, the Reserve Bank of India, the Central Bank of Russia, the National Bank of Poland, and dozens of other institutions are all buying gold simultaneously, they are not acting on a hunch. They are acting on information. They know that the current system is unstable. They know that a crisis is coming, and they are preparing. Every single data point confirms the same conclusion. The debt calendar is locked. The yield curve is inverted. Central banks are hoarding gold. The infrastructure for a CBDC is already built. The safety net for regional banks has been removed. The trap is set, the fuse is lit, and the timeline is 2025. There is a framework for understanding this moment that goes beyond economics. It is a framework of cycles, of generational patterns, of recurring crises that reshape society. This framework is called the fourth turning, and it was articulated by historians William Strauss and Neil Howe in their book of the same name published in 1997. The theory is this. History moves in cycles of approximately 80 to 90 years. Each cycle consists of 4 turnings, each lasting about 20 to 25 years. The first turning is a high, a period of strong institutions and conformity. The second turning is an awakening, a period of spiritual upheaval and questioning of authority. The third turning is an unraveling, a period of weakening institutions and individualism. And the fourth turning is a crisis, a period of destruction and rebirth, where the old order is torn down and a new order is built in its place. The last fourth turning in American history was the period from 1929 to 1945. It began with the Great Depression, the collapse of the financial system, mass unemployment, and social chaos. It culminated in the Second World War, the total mobilization of society, and the complete restructuring of the global order. Out of that crisis came the Bretton Woods system, the United Nations, the dominance of the U.S. dollar, the welfare state, and the geopolitical architecture that defined the second half of the 20th century. If the cycle holds, and Strauss and Howe argue that it does, then we are now in the next fourth turning. It began, arguably, with the financial crisis of 2008. That was the warning. The institutions failed. The banks were bailed out. The social contract fractured. Trust in government, in media, in experts began to collapse. The unraveling accelerated. And now, we are approaching the climax of this turning. The crisis that will force a reorganization of society. The pattern is always the same. The crisis destroys the old system. There is chaos, suffering, fear. And in the aftermath, a new system is imposed. The people who lived through the Great Depression accepted the New Deal, accepted the expansion of federal power, accepted the end of the gold standard, because the alternative was starvation and disorder. The people who lived through World War II accepted the surveillance state, accepted the military-industrial complex, accepted the United Nations, because the alternative was fascism and totalitarianism. And the people who lived through the crisis of 2025 will accept the CBDC, will accept the consolidation of the banking system, will accept the monitoring of every transaction, because the alternative will be presented as financial collapse and anarchy. The crisis is not an accident. It is the mechanism by which the new system is born. This is the historical echo. Every 80 to 90 years, the system resets. The last reset was 1945. 80 years later is 2025. The cycle is closing. The crisis is the birth canal of the new order. And those who understand this pattern can see what is coming with brutal clarity. Let's return to where we began. On the 11th of March, 2024, the Federal Reserve terminated the Bank Term Funding Program. The safety net was removed. The system was made fragile again. This was not an oversight. This was not a technical decision. This was the final preparation. In 1980, Paul Volcker raised interest rates to 20%, knowing it would trigger a deep recession. Knowing it would cost Jimmy Carter the presidency. He did it anyway. The precedent was set. A Federal Reserve chairman can and will use monetary policy to destroy a presidency if it serves the institution's objectives. In 2024, Jerome Powell held interest rates at a 23-year high, long after inflation had been defeated. He held them there throughout the election year. He ensured that the delayed impact of those high rates would not arrive until 2025. He removed the emergency backstop for banks. He set the trap. $1.5 trillion in commercial real estate debt is coming due. The regional banks that hold that debt are exposed. The FDIC cannot cover the losses. The yield curve has been inverted for over 18 months. Central banks are buying gold at 1,971 levels. The FedNow system is operational and waiting. Every piece is in place. A new president will be inaugurated on the 20th of January 2025. And within the first 100 days of that administration, the crisis will begin. The first regional bank will fail. The contagion will spread. The markets will collapse. The media will blame the new president. The crisis will be framed as a political failure, not a structural inevitability. And in the chaos, the solution will be offered. The digital dollar, the CBDC, direct deposits from the Federal Reserve, instant relief, efficiency, modernity, safety. The public will accept it because they will be desperate. And in accepting it, they will accept the end of financial privacy, the end of cash, the end of independence. The crash is not the end. The crash is the permission slip. The crisis is the pretext for a system of control that has been designed and built over the past decade. The infrastructure is ready. The legal authorities exist. The only thing missing was the emergency. And the emergency is being engineered for early 2025. Paul Volcker broke inflation in 1980, and he broke a presidency. The question is not whether the Federal Reserve will trigger a crisis again. The question is, what will they build in the ruins? What will the public accept when they are told there is no other choice? The trap is set. The fuse is lit. The calendar is counting down. And when the trap snaps shut in early 2025, the world will be told that this was all inevitable, that no one could have seen it coming, that the system simply failed. But that will be a lie. This was not a failure. This was a plan. And the plan is almost complete. The clock is ticking. The trap is set. And history is about to repeat, not as tragedy, not as farce, but as a calculated act of monetary warfare designed to reset the system and consolidate control. The only question that remains is whether enough people will recognize it for what it is before it is too late. When the trap snaps shut, will you see the mechanism, or will you believe the explanation you are given?